Welcome everybody to Safe Option Strategies and to our presentation of fundamental analysis. The following presentation is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. Any live trades discussed in this or any Safe Option Strategies class are additionally for education purposes only. There is no recommendation, implied or otherwise, to place these trades with real money. Okay, we are going to talk about fundamental analysis of companies. When you're trading stocks and options, when you're trading commodities, futures, there are, generally speaking, two types of analysis that people will do as they set up a trade. We're going to get in our next two classes, we're going to get into technical analysis, and that has mostly to do with chart reading, looking for patterns in charts. Fundamental analysis has more to do with the financial health of a company, and you could even go specific to saying the financial health of a company relative to the current value of the company. What fundamental analysis is typically used for, when you're listening to the news, when you're listening to financial stations on the radio or on television, they talk about the valuation of the company. Is it undervalued? Is it overvalued? And that's where a lot of fundamental analysis comes into play. It's what is, based on the financial health of the company, do I believe the stock is trading for more money than it should trade right now, or do I believe the stock is trading for less money than it should trade right now? And that's going to be one of the things that helps me determine which direction am I going to trade. If I'm just buying or selling the stock, is it time to get out because it's overvalued? Is it time to get in because it's undervalued? And so that's what we're going to focus this presentation on. The definition that comes right out of Investopedia.com for fundamental analysis for stocks. Fundamental analysis uses revenues, earnings, future growth, return on equity, profit margins, and other data to determine a company's underlying value and potential for future growth. All of this data is available in a company's financial statement. So a few of these things that it talks about: revenue, of course, how much money is coming in, earnings, after-tax net income, bottom line, or profits. Profit margin is the net income divided by the net sales. Future growth is a tough one. Future growth is how much we believe we will grow. And that's coming from the company. When you're talking about fundamental analysis, there are independent analysts who will tell you how much they think the company should grow. But when we're evaluating company data, we're going to look at the company's own information oftentimes and figure out how much they believe they're going to grow. Return on equity, I'll leave that on there for a second. Net income divided by the shareholders' equity. Return on equity is a measurement of how well the management of a company is doing in creating profit from what it's had. Another way to look at it is how good are they at spending their money? How good are they at managing what they have and producing more for the company and for the shareholders from what they have? So, these are a few of the things that go into fundamental analysis. Now, my favorite way to explain fundamental analysis to someone who is new to the stock market, I think there's a shortcut and an easy way to determine the fundamental health of a company or whether you think a company is in good financial shape or not. And it starts with an easy comparison of what you would do sitting at your own kitchen table, sitting in your own home office, sitting down with your spouse or your partner or by yourself and determining your own financial health. When we look at big companies, when we look at a company like Boeing, when we look at a company like Apple that's worth over $1 trillion, a company like Amazon who at times seems like they're going to take over the world. When we look at big companies like this, unless you're a former or current CFO of a big company, it can be overwhelming when you look at the balance sheet and when you look at the numbers and all the different places that money comes from and all the different things that money is spent on. And you're looking at numbers that are millions and billions of dollars versus your household income that might be tens or hundreds of $1,000s. And it becomes overwhelming. But when it's your own home, when you're looking at your household budget, it's relatively simple. How much money do you have in the bank right now? What are your total assets worth? What's your income? How much money is coming in right now? How much debt do you have? What are your fixed expenses? It's easy once you have this information to figure out what does your financial future look like. You look at your job and you say, gosh, I'm a junior level executive, and I seem to I like my job. I work hard. I'm getting some praise for doing a good job. And so my future looks bright, provided the company is still around and in shape. You can determine all these things relatively easy when you're doing it on a small scale in your household. Apply that same thought process to any publicly traded company. How much money do they have in the bank? We often just refer to that as cash on hand. How liquid are they? Let me pause before I go on to their total assets and the worth of them. How much money do they have in the bank? During the recent COVID-19 pandemic in the early part of 2020, there were a lot of publicly traded companies, some well-known named companies, that filed for bankruptcy or went out of business completely. There were other companies that were able to weather that storm. A lot of times, in many of those cases, it came down to the company that had more cash on hand and less debt, or at least a better ratio of those numbers, was able to survive this unexpected crazy event. And the companies that had less cash in the bank and more debt, or just a worse ratio of those numbers, are the companies that struggled with it. Isn't that the same also as in our household? When economic times get tough and people get laid off, the people that have more cash in the bank and fewer debts have a better chance of riding it out until the next job comes along, or riding it out until some retirement money kicks in. The people that are living a little too close to the edge are the ones that struggle with it. It's the same with companies. So how much cash do they have in the bank? How much money do they have on hand? What are their total assets? What's their revenue? What is their debt load? What are their fixed expenses? What does their financial future look like? You're applying the same thought process, and forget about the fact that it's on a bigger scale. Bring it down into a very easy to understand situation and make the comparison. If I'm looking, let's say hypothetically, let's say I'm a bank and I've got a couple of people applying for a loan, for whatever it might be. I look at one individual and I say, okay, Carol's income is $7,083 a month. She makes around $85,000 a year. She's a single mom. She has a mortgage. She has a car she pays for. She's got a little bit of credit card debt, nothing horrible, but a little bit of credit card debt that creates a monthly payment. And she's still paying off some student loans, including having to take care of some daycare. She's got fixed expenses. She puts a little bit of money into savings each month. And her new company that she's working for, she makes a contribution into her 401k. And then she has maybe $750 of discretionary spending. And at the end of an average month, she's got about $448 of wiggle room. Now, if I'm someone who may be considering loaning her money, I'm going to look at that and say, okay, she's got enough coming in to cover all of her expenses, but she's in a fairly new job, has kind of a big mortgage payment for the amount of money that she's making, and a little bit of credit card debt, and she might be able to cut down a little bit on discretionary spending, but her fixed expenses relative to everything else might be a little on that. Fixed expenses like the gas bill, the electric bill, the cable bill, cell phone, things like that. So then we look at the Jones family. They both work, and together they make almost $150,000 a year. They've got a mortgage relative to their income that's a little more in line. They have 2 cars, but they didn't go out and get crazy expensive cars, so the combined payments are not too bad. No credit card debt. They worked hard right out of college and paid off their student loans. A little more daycare expense, so they've got some higher fixed expenses, but they're able to put $2,000 into savings every month, $1,500 contributed to their own personal IRA, and they've got wiggle room of $1,500 every month in discretionary spending, still with almost $2,000 left over each month. if I'm a lender at a bank and I'm analyzing these two situations, it's easy for me to determine who might be in a better situation right now and who might be more deserving of that loan if I had to choose between the two. Take that same principle and apply it to a company. Sometimes the information, if we're not from an accounting background, we look at something like that bottom line that says book value per share. We look at quarterly earnings growth, diluted earnings per share right there in the middle. And we say, you know, those terms don't make a lot of sense to me, but that's okay. They don't necessarily have to. We can see how much money these two companies are bringing in. There's their revenue. We can see how much of that revenue translates to gross profit. That's basically what's left over after all their expenses. We can see how much cash they have on hand. 3.18 billion versus 788 million. We can see how much debt they have, 6.66 billion versus 1.38 billion, or excuse me, 1.3 billion. So we don't have to be from an accounting background. It's relatively easy to take a look at these numbers and recognize fairly quickly, is this a company that could weather the next storm? If I'm going to put, and I purposely chose two companies that are competitors of each other, Nike and Under Armour. If I could invest in one of these companies but not the other one, will these numbers make a difference on who I invest in, especially if I'm going to buy stocks? Now, it can be a little bit different, and we'll get into this more in our technical analysis classes, but it can be a little bit different when you're doing a shorter term trade that involves options only, and you may temporarily like to trade a company that you think has some weak financials and may be poised for a bearish move, and you've got a trade that could take advantage of that bearish move. That's absolutely fine. But especially if you're going to invest money in stock ownership, you want to know some of this basic information. Is this a company that could weather a storm? I don't know if we'll have another black swan event like the COVID-19 pandemic, and neither do you. It's probably inevitable that we do have something else like that happen, but we don't know when. If I'm going to put money into a company, I've got to ask myself every time I do it, is this a company that could weather the storm in an event that is unexpected like that? Just for your information, these two little graphics that I have for the income statement and balance sheet, I just went to Yahoo Finance. The actual web address is finance.yahoo.com. You can pick any company, and once you've pulled up that company, you can click where it says statistics, and that's where I got this information. And you just scroll down the page and you can find this. So this is easy information to find. I'll go into that a little bit more before the end of the presentation on where to find some different information that you need. So to me, the first part of fundamental analysis is just look at the financial health of the company, the general broad picture of a company's financial health. Now, part of fundamental analysis in the way we teach stocks and we teach options involves creating a watch list of companies. This may seem like it's a little bit of a tangent away from actually studying fundamental analysis, but one thing I want everyone to do as they go through the Safe Option Strategies education, as they learn the strategies and the methods that we teach to trade stocks and options, everything you do going forward is going to be easier if you create a watch list of fundamentally sound companies. And the watch list can be as little as 10 to 15 companies, preferably at least 3, maybe 4 different sectors of the market. For example, if I were going to develop a list of 15 companies that were going to be my primary watch list, I would start with maybe 1 or 2 companies that are in the retail sector. I would definitely have a few companies that were in the tech sector. And there's a lot of crossover now in those. You could certainly say a company like Amazon is in the retail and the tech sector. I would probably have a couple of industrial companies like Caterpillar or Boeing on my watch list. I may have an airline stock in there. I may have some other travel stock in there. Under Armour and Nike are in the retail business. But they have kind of a niche in that business. So I may choose something like that. Have 3 or 4 different sectors represented in your watch list, and your watch list should primarily be made up of companies that you know. I think I may have it on one of these bullet points later on in the presentation, but one thing that I have taught since the day I started Safe Option Strategies is trade the companies you know and get to know the companies you trade. Okay, that's I don't even remember if I heard that from someone else or if I may have coined that myself 15 plus years ago. Trade the companies you know and know the companies you trade. Part of knowing the companies you trade is know at least a little bit about their competitors. One of the key reasons for knowing about their competitors is knowing whether or not a really good financial earnings report from a competitor may send a company that you're trading up or down based on the strength or the weakness of that report. Some companies react very favorably when their competitors are doing poorly. Other times, a company may mirror what their competitor is doing because the industry is so tightly knit that bad news for one company in that industry is kind of seen as bad news for all of the companies in that industry. So these are important things to know about. Always be aware of when the next earnings date is with the company you're going to trade. We get a lot more into the importance and the significance of earnings dates as we get deeper into the education, but always be aware of when that next earnings report is coming up. Find a reliable source for news for the companies that you trade. Generally speaking, I like finance.yahoo.com as a place to scan. I also like cnbc.com. I don't have that one listed on here, but I like them as a place to easily go and scan headlines for what's happened, what's been written about a company that I'm trading. And so make sure you have a reliable source of news. And then you're going to, of course, study past performance around major events like earnings and look for patterns. We get into a little more technical analysis when we start talking about that. But a very good spot to start your journey and your process of trading is to create that watch list of companies. And every company on that watch list should be a company that you feel is financially sound. Now, let me talk just a little bit about trading companies that you like or trading companies that you know really well. And let me give you an example of some good and some bad, or maybe a better way to say it would be some of the do's and don'ts of companies on your watch list. If you are morally opposed to what a company does, what product they produce, what sector they operate in, how they derive their profits, if you're morally opposed to them, don't trade them. Don't trade them. If I'm someone who is very against the recreational use of marijuana, I'm just using this as an example. If I'm someone who morally is very opposed to that, I'm not going to invest my money, even though it may be a good future investment. I'm not going to put my money into a company whose primary source of income is cannabis, marijuana. I'm not going to do that. I don't trade tobacco companies. I don't judge people who, I don't judge anyone who smokes. I imagine that is a very, very difficult habit to get out of, and I feel for those individuals, and I wish them the best when they try and quit, and I hope that they last a long time even if they're not trying to quit. But I don't smoke. I don't like smoking. I don't invest in tobacco companies. Now, that's an easy one. That's a very easy one to look at it and determine. What is a little bit harder is when you really, really like a company because of their product or because of the service they provide, and your like of that company or love of that company may cloud your judgment on always being overly optimistic about what that company is going to do. I'll give you a personal example. I loved the fact that back in 2008, 2009, one U.S. automaker chose not to take any government bailout money, and they weathered that storm, and they came out of it strong, and they've continued to produce good products, and that company is Ford Motor Company. Now, ironically, I'm not a Ford person like when you talk about people being I'm a Ford guy or I'm a Chevy guy. I'm not like that. I when I shop for a car, I look for the best value on a car that I like, and I've owned Mazdas, and I've owned Fords, and I've owned Chevrolets, and I've owned Kias, and I've owned Toyotas, and I've owned Nissans. I've owned a number of different cars. I'm not stuck on one, but I've really admired Ford Motors. That has admittedly, I have to be really careful because that at times has clouded my judgment a little bit on Ford. It's a little bit hard for me to see past my own like of the company or love of the company and look at the numbers and say, you know what, as much as I like what the company has done in the past, they may not be a great investment right now. And so when I talk about know the companies you trade the companies you know, be careful that you never get too sentimentally attached to a company, and make sure you're not completely staying away from a company for silly reasons, unless you are in fact morally opposed to what they do. Let me give you one quick example on that. A year and a half or 2 years ago, when there was a little bit of a politically correct push, there's been a lot. I mean, our country is, most of the world now is almost overwhelmed by political correctness. But there was this push on transgender or non-gender bathrooms. And Target, the big retail company, the big department store, Target was one of the first large retail stores who came out and said, we're no longer going to have gender-specific bathrooms. Now, there's nothing Target has done in the past or since then that gives me reason to not, to not want to invest in them as a company, unless I just already had some retail stocks I was investing in or didn't have room for them in my portfolio. But that decision that they made really bothered me. It didn't sit well with me. I've got, they're both young adults now, but I imagine being the father of a couple of daughters who would need to go to a bathroom at a department store, and then some creep could go into the same bathroom at the same time because Target had a non-gender bathroom policy. That did not set well with me. But I've got to be careful that one dumb decision, in my opinion, that one dumb decision by some misguided people in management doesn't keep me forever from trading Target. So be a little bit careful, but trade companies that you know. If for no other reason, it's easier right out of the gate to know more about the company that you know. A lot of times students will text me or email me, and they'll want my thoughts or my insight or my input on a company, and they're sharing with me a company that I don't know. And so I can give them a really quick opinion on technical issues. I can look at a chart and say, well, I like that they're in a strong growth mode right now, and they just broke through a level of resistance, and I can share things like that with them. But if I don't know the company, I'm at a loss, and I don't know at times how much research I want to do into that company. A couple of things you should know, not only about the companies you trade, but about their competitors, that is part of the overall fundamental analysis. Is the company you're trading in a strong industry? Is the overall sector strong? Is it a seasonal sector? If you're going to trade a couple of companies in a particular sector, is it something where almost always, with rare exceptions or with pandemic type black swan exceptions, are they typically a strong fourth quarter company because they're in retail? Are they a stronger summertime company because they're in travel? So make sure you know if they're seasonal at all, and then know how is the company that you're trading. I mentioned this before. How is the company you're trading affected by the news of its competitors? There have been times where a news report would come out on Nike, or Nike would report their earnings, and Under Armour would have a movement right after that would sort of shadow what Nike was getting from the report. And it's because they're competitors, but their news that was good for Nike was perceived as news that was good overall for the industry. Sometimes you get the exact opposite of that. Apple and Samsung. If Samsung reports record-breaking sales and an increase in the market share of cell phones, that might be bad news for Apple, and Apple might dip a little bit on news like that. So if you're trading Samsung or if you're trading Apple, it might not be a bad idea to, at least in the periphery, pay attention to what's going on in the news that's happening with a company like Samsung. If you're trading Apple, pay a little bit of attention to Samsung. To really have good fundamental awareness and fundamental soundness of the companies you're trading, you've got to become a little bit of a news junkie. Now, I'm not suggesting here that you spend time every day to the tune of an hour or 2 or 3 hours watching the news or reading news articles. You should get in the habit daily of scanning news headlines. And then every once in a while, as you're scanning those news headlines, take a look at the headlines that sound, at least on the surface, a little more impactful. I brought these news headlines up as it relates to Nike, and wouldn't you know it? There's in this headline on Nike, strong innovation, digital growth, and partnerships key to something. And there's a headline that says Under Armour, the recovery may be years away. Under Armour's news affects the news on Nike, and vice versa. So become a little bit of a news junkie, at least in looking at these headlines on a daily basis, and maybe occasionally dive into the article and see what it's saying and whether or not. Now, I will caution you on this. Sometimes you'll read something or you'll see a headline and you'll think to yourself, that's pretty big. That's kind of a big deal. And then there's no effect of any kind on the stock in the next day's trading or later in that day's trading. Other times you'll see a headline that seems somewhat innocuous and you're thinking, oh, that's not that big a deal. And lo and behold, it's pushing the stock dramatically one direction or the other. Sometimes it could be the source of the article, the credibility or the reputation of the person or the organization putting out the article. Sometimes it comes down to whether or not the company themselves, through a spokesperson, confirmed some part of the article or denied some part of the article. But it doesn't have to be over the top. It doesn't have to consume your day, but become a little bit of a news junkie as it relates to the companies that you trade. Every single company that is publicly traded has an investor relations website. And 99% of the time, you can find those investor relations websites by doing a Google search, or a lot of times now in our address bar of an open web page, we just begin typing Nike Investor Relations, and we'll see a website that will come up. Under Armour Investor Relations, Ford Investor Relations, Apple Investor Relations. And you'll go right to a site that will give you a lot of the fundamental information that you're looking for. When I pulled this one up just before doing this presentation, you can see that Under Armour makes available to you some of its financials, some of its stock information, press releases and events and presentations, other resources, annual reports, and their most recent earnings. These are all things that are a part of the fundamental analysis of the company. One of the big things you look at, companies will report this themselves, and you can look at historical data, and then you can look at future data. This is historical data. This is what I'm looking at right here. This particular line right here is the gross profit. From 2016 to 2017 to 2018 to 2019, every one of those years, gross profit is going up. Would you rather say, this is a rhetorical question, you don't have to answer, would you rather see that going up, or would you rather see it going down? Obviously, especially if you're going to buy stock in a company, obviously you would like to see it going up. on a diagram like this, there's probably only a few things that you need to look at. Make sure you're aware of things that are one-off, other income and net and expenses. There was probably a one-time big expensive write-off that took place in the fiscal year that ended in May of 2018. You can see that's pretty obviously an anomaly. So make sure when you're looking at numbers like this, you recognize that every company is susceptible to an occasional anomaly in these numbers that they report, but look for things that are moving in the right direction. It's not a bad idea to know who's at the head of the company. This is the profile, the company profile for Nike. This is the one name that probably you recognize. Phil Knight has been kind of a famous figure in the business world for quite a few years. Phil is one of the founders of Nike. I know very little about Mark G. Parker, who's the current executive chairman. I know very little about, I know the name and I know a little bit more about John Donahoe, who's the current president, CEO, and director. If I know that the executive chairman is making $5.92 million a year and I'm making $105,000 a year, I better be already independently wealthy, or I better be really upset about my compensation. I'm joking around a little bit. I think John Donahoe is one of these CEOs that voluntarily works for a much smaller pay and much smaller compensation. And why would that be important when it comes to doing fundamental analysis? I admire someone who, I never begrudge a multimillionaire that earned their money. I don't have a ton of respect for the ones that the trust fund babies that just inherited it. But I don't dislike them. I just, from a business standpoint, they haven't done anything except be born to the right family. But someone who's made their fortune, made millions, and doesn't need to continue to get paid millions of dollars a year, I have a lot of respect for someone like that. And I'm probably going to give them the benefit of the doubt a little bit more if there's stuff going on in the company that I need to be aware of or that I need to be concerned with. So it's not a bad idea to know who's at the head of the company, who's running things. You're going to get this information more from independent analysts, but most companies, when they report their quarterly earnings 4 times a year, will share information about what they think the future holds. But more often than not, you're going to get this through independent analysts. And look for companies that where the analysts think that the revenue is going to increase each year. A consensus of these analysts think that average estimate of revenue is going to increase next quarter and increase a lot from this current year to next current year, or to next year. Sorry, this current year to next year. But go back to what I said earlier in the presentation. One of the key aspects of what the future holds has to be what kind of financial health is the company in? Are they going to be able to weather the next storm? So these are all things that are good. Now, let me go into this, and then we'll kind of wrap things up for this particular presentation. You don't have to become a financial expert to do fundamental analysis on companies. It's not required that you know every line item in the budget of a company so that you can determine if they're spending their money on the right things. If a company has a history of spending money on mergers and acquisitions, and they've more often than not been profitable, then at least until they prove you otherwise, you don't have to be an expert on the other companies that they're acquiring or picking up. What you've got to do is say, you know, this has worked out really well for them for several years, and it's the same management team that's running the company. I think I'm going to trust them that when they go out and acquire another company, they know what they're doing. I'll give you an example that hopefully you already have connected these dots, but he's one of the younger multi-billionaire CEOs still to this day in the country and in the world. And it seems to me that Mark Zuckerberg at the head of Facebook kind of has the Midas touch. Facebook spends a fair amount of money each year on acquiring other companies. For the most part, that has paid off really well for them. I scratched my head a little bit when Facebook acquired Instagram a couple of years ago. Do you know what Facebook's #1 profit center in its corporate umbrella is right now today? It's Instagram. Facebook derives a bigger percentage of their profit from Instagram than any other segment of their business. That's been the case more often than not with Mark Zuckerberg and with Facebook. So if I hear news that Facebook is going to acquire another company, I don't have to become some expert analyst myself and dig into the pros and cons of Facebook acquiring that company. I can look at the track record and say, you know what? No guarantee this one will pay off like the last one did, but they've got a pretty good track record of making this work. So that's just kind of a little anecdote to illustrate. You don't have to become an accounting expert or a financial expert to still have the ability to do good, sound, fundamental analysis of the companies that you're considering trading. A handful of helpful links that might help you out: stock charts, Yahoo Finance, CNBC.com, and any company's name followed by investor relations in a Google search will take you to that company's webpage where you can find a lot of this information. Admittedly, even amongst big companies that seem to be incredibly tech savvy, you'll find a varying degree of usable information on their investor relations pages. I am shocked at a couple of behemoth companies that, in my opinion, have horribly unorganized, oftentimes not up to date investor relations web pages. I'm talking about some huge multi-billion-dollar companies, trillion-dollar companies in one case. I'm shocked when I go to their website sometimes looking for information on their investor relations site, and they're 3 days away from their tentative earnings date, and it's still not under their list of events for upcoming events, the scheduled time of their next earnings conference call. That drives me crazy, but it is what it is. You'll see a big variance in that. Whether you're trading bullish or bearish, stay away from companies that are not fundamentally sound. That's a good general rule of thumb. Don't trade companies you don't like. If we've traded American Outdoor Brands Corporation, formerly Smith & Wesson Holding Corporation, for years. If you're an anti-gun person, don't trade Smith & Wesson. Don't trade American Outdoor Brands Corporation. That's okay. That's your prerogative, and you're not right or wrong for your opinion. Well, you're right in your mind, but your opinion is not wrong as far as we're concerned. It's just your opinion. But if you don't like the company, don't trade the company. Build a watch list. It can start out small and build up over time. I would recommend, when you put together a watch list of fundamentally sound companies that you're going to look for trades on, I would recommend that at the most you get 30 companies that you're keeping an eye on. And that doesn't mean that you don't pay attention to a lot of other companies. That doesn't mean you're not aware of other big name companies and what they're doing. But as far as your watch list that is mostly going to consist of companies that you would do a trade on when the timing is right, and we'll get into that more in our technical analysis classes, I personally, I would max out around 30 companies on a watch list. Never underestimate the value of due diligence, doing your homework. When you look at the number of people, individuals like you and I'm not talking about fund managers, I'm not talking about brokers, I'm not talking about large investment firms. I'm talking about individuals like you and me. When you talk generally about the people who are trading the U.S. stock markets day in and day out, probably 75% of them trade almost purely on technical analysis, and they never take the time to do their own fundamental analysis. And that doesn't mean they're ignorant of fundamental analysis. They're listening to news sources, they're listening to the talking heads that are on the financial news stations, and they're aware if a company like JCPenney is going into bankruptcy. They're aware if a company like Pier 1 Imports is going out of business. And so there you can glean some general awareness of the fundamental soundness of a company just through the headlines and what you hear on the news and see on the television. But don't underestimate the value of doing a little bit of your own homework and digging in just a little bit more than what the average person will do, so that when you're placing trades, whether there's collar trades that involve stock ownership, whether they're option-only trades like the spreads, when you're doing your trades, make sure you're doing a mix of fundamental and technical analysis, and you're just going to be better off. The more information, the more knowledge you have, the more news you're willing to look at, the the more educated your guesses are going to be. Never forget, every trade you place is an educated guess. You are making an educated guess on what direction that stock is likely to move. Make those guesses as educated as possible, and you'll simply increase your chances of being right far more often than you're wrong. That concludes our class on fundamental analysis. I believe the next class coming up is part 1 of technical analysis. Thank you. Goodbye.